Welcome, everyone. My name is Blake, and I will be your moderator. I'm excited to welcome Bob Gray, owner and partner of Gray Pilgrim and Associates, LLC, as our speaker tonight for a review of the 2022 tax laws. Before we get started, I'd like to take a moment to go over some housekeeping. If you have a question, please type in the box labeled "Have a Question" on the right side of your screen, and we will be able to answer them live at the end. Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand. Bob, welcome and thank you for being with us tonight. I will pass it over to you now.
All right, thank you very much. So welcome everyone. Here we are as the summer winds down. It's the perfect time to get a head start on some year-end tax planning, so I'm glad you could all join me. As part of the disclosure, we must say, of course, that Schein is not offering any tax advice specifically here. You want to check with your own personal tax advisor. But the point of the presentation tonight is to kind of light the fuse and bring out the conversation. So hopefully that you'll enjoy this tonight. I am Bob Gray, and I'm happy to be one of the founding members of the Academy of Dental CPAs. I don't know if all of you've heard of that, but it's an interesting group, an organization. I'm also an instructor at the Dental Business Institute and the Business of Dentistry courses that were pre-pandemic, presented around the United States and even in the Caribbean and Hawaii, by the ADCPA, but I've also done a lot of lecturing to the dental societies all over the U.S. And so I think that's how I got pinned for tonight's presentation. I'm an accountant, but I'm also a super wine enthusiast. And my wife and I, Susan, love going to Napa and chasing those little tiny boutique vineyards and trying to, seek out those 100-point wines that no one else can seem to find. I'm also quite an adrenaline junkie. That's a Cadillac CTS-V that's been modified to about 900 horsepower. So, some accountants are a little crazier than others. I'll go back to the ADCPA. I want to give a quick shout out to all my fellow accountants in the ADCPA across the land here. The ADCPA is an organization of accountants, all of whom are focused in the dental industry. They're not just accountants who happen to have a few dentists as clients. These are people that all are in the industry, teaching as I am doing tonight, writing for dental economics, and very involved in the dental space. And so they're very aware of what's going on and I think much more helpful than your standard accountant. And we're located all over the United States. If you go to adcpa.org and look at your location, you'll find an accountant that's near you. The question comes up all the time, so aren't the tax laws all the same? Why would one accountant be different than the other? But I would tell you that if you have an accountant who actually knows what you do and knows what questions to ask, that seems to be the key. Because quite often I talk to dentists who say, well, if I call my accountant, they would give me the right answer, I think, but I didn't know which questions to ask. And so, having an accountant that knows mesial from distal and can point to tooth number 8 means that they understand the industry and they understand the questions that they should be asking you so that you can actually minimize your tax and help manage your practice. So let me get into what we're going to talk about here tonight. I'm going to talk very briefly about some PPP loan forgiveness. That's pretty much in the past, but there are a few of you that may still have this lingering issues and you've got tax returns that are still on extension. So we're going to talk about that briefly. I want to spend some time talking about the qualified business income deduction. That's important and very important factor that's popped up in the post-2018 tax rules. And I'm surprised how many people still don't really have the opportunity to do the right planning for that. We're going to talk about that. We're also going to talk about different retirement plans and what's available. I often do reviews for dentists and find that they just have the wrong size shoe on, so to speak. They have a pension plan that has maximums that are too small. They're not maximizing their goals. And so you want to always ask yourself the question, do I have the right plan? We'll talk about that in more detail. And talking about maximizing itemized deductions, many of you are probably aware that there was that SALT, the state and local tax limitation, that got stopped at $10,000. Well, that significantly impacted people's ability to itemize their deductions. And so we'll talk a little bit about how to maximize that tonight as well. We also have a number of other topics on Roth IRAs, some planning tips, but I definitely want to leave time for questions at the end. The point of one of these programs is when you've got a free accountant here tonight and you can type in a question and it's a complimentary answer, take advantage of that. To the people that ask questions tonight and I can't get to them on the program, go ahead and put them in the box, send them in. I will try to get to email responses, as many of those people as we possibly can. In the past, I've been able to get to them all, so don't hesitate to ask a question if you think I can help. The one thing that people ask me all the time is, well, hey, how do you save taxes? It's funny, but people don't realize how much difference there are in state income taxes. If you were sitting in Los Angeles, you'd have a maximum tax rate of over 13%. That exact same practice sitting in Seattle has a 0 state income tax. And so I know that many of you are not really planning on moving your practice, but for those of you that are looking to either relocate or you're on tonight, you're thinking of starting a practice, and you can spin the globe and put it wherever you want to, realize that the state that you pick has a very big impact on the total amount of tax that you'll actually pay. This is what I just wanted to touch on for the PPP loan forgiveness program. If you had a PPP loan and it was forgiven, I think everyone understands that, in fact, it was not taxable income. That's great. I also got to tax deduct the expenses that I used that money for, which is good. But the other thing people don't realize is that the SBA paid interest to the bank that gave you that loan. You never actually had to pay it, but the SBA paid it. And it's part of your record at the SBA when you pull down the total loan history. And the loan that loan interest is the same as any other expense that was used with that money. It's interest deduction for you. If you didn't take an interest deduction, you may want to consider the possibility of an amended return, or make sure if you're on extension and you had a loan forgiven in 2021, that you pick it up on this year, because it's maybe a small deduction, but it's certainly one that you don't want to overlook. I talk about maximizing itemized deductions. This is what I talked about, the SALT limitation. For 2022, a joint taxpayer gets $25,900 worth of, quote, itemized deductions for free. In other words, you don't have to have any charitable contributions, any mortgage interest, anything, and you still get $25,900 for free as a base. So when you talk about itemizing, that's because you've gone over that $25,900. The problem is for those married folks is that only $10,000 of that can be state and local income taxes. Given that $10,000 limit, obviously there's only $15,900 left for other things. Where interest rates, although they're creeping back up, have been low for some time prior to all this. So there's a lot of people sitting out there with 3% and 4% mortgages. So it's pretty difficult to spend $15,000 in mortgage interest when you are maxed out at $1 million, and the rest has to be charitable contributions. So I want to point out this particular example. Let's say that in this the first column, it just says even gifting. I usually give my charity $3,500 a year. And so my total of the standard deduction is only $25,500. And so I didn't beat the $25,900. So it didn't really help me. The $3,500 that I gave away had no impact whatsoever on the tax that I will pay that year. Now let's go over to the right-hand column and say, oh, well, what if I said to my charity, tell you what, I'm going to give you $3,500 in December this year, and I'm also going to give you $3,500 for 2023 in December. That's my 2023 commitment to you as a charity. If you did it all in 1 year like this, now you can see you would have $7,000 in charitable deductions, and then you would beat the itemized standard deduction of $25,900. You'd have $29,000, and you'd save $1,560 in this example because you actually bundled those into 1 year. So it's the same amount of spend. It was just a question of how can I kind of condense it into 1 year. One of the other things to talk about in this SALT limitation, though, is that many of you live in states. If you have an S corporation or a partnership or an entity, many of you live in states now where the states have tried to help people do a workaround for this SALT. If I have an S corporation, for instance, in, say, Illinois, I'm allowed to have my S corporation actually make estimated tax payments on my behalf as a corporate deduction, that's a big deal because, again, depending on your income, and again, it applies to California, but many, many other states with state income tax. In the past, I would just get a K-1 form, and I would have to make all my own state estimated tax payments out of my own pocket. Under the new rules, you can actually have your corporation elect to pay what's called pass-through tax. That corporation then takes a tax deduction for it, which you wouldn't have been able to because it was limited to $10,000. And then your K-1 says, well, here's the amount of income, but I've also prepaid this amount of tax. Take a credit for it on your personal return when you file. So make sure you're maximizing the option for if you have a partnership, S corporation, some other entity in your particular state, make sure you're maximizing the opportunity to, again, do the workaround for the SALT limitation of only $10,000. I want to talk a lot tonight about the qualified business income deduction. This was created in 2018. It's 20% of your qualified business income, and this is not W-2 income. It has to be from a business. So sole proprietorship, partnership, S corporation, all of those entities that you may be practicing under in your various entities, that income that comes through to you on a K-1 form, or that shows at the bottom of your Schedule C as a sole proprietor, is subject potentially to a 20% reduction. It means you only pay income tax on 80% of that number, which is a huge tax deduction for many people. The problem is, remember that I said that W-2 income does not count, so S corporations need to plan carefully. You probably want to try to get some salary depending on your pension goals. You certainly want some salary so that you're qualified for your pension. You also need to take what's called a reasonable salary from any S corporation. You're not allowed to just say, oh, well, I'll just take all my money as a K-1 then, and I don't want to take any W-2. The IRS hasn't really ever defined reasonable salary for a dentist. I think if you look back, we tend to use the government guidelines. If you look at the stats that are published, the average dentist in the United States, I believe in 2020, when the report was published from the Department of Labor, made somewhere in the $180,000 range. Now, it'd be hard to argue that if you have actual income of $500,000, that you really shouldn't have taken at least $180,000 as salary. Many accountants use sort of the 50-50 rule, is that maybe at least if half of your income was on a W-2, the other half could be on a K-1. But you talk to your advisor about what that particular item is. But what you want to try to do, the point is minimize, to the extent reasonable, minimize your W-2 so that you could maximize the amount that's eligible for this QBI deduction. So you have to balance those K-1s and W-2s. And again, if you have a loan that was forgiven this year, that has no impact on your QBI deduction. I'm going to show you an example coming up here in a minute about exactly how that calculation would work and why the planning could be so important. Let me use this. I'll start with this as an example about purchasing dental equipment and how that really reduces taxes. And then we'll sort of weave that right into that QBI calculation so I can show that to you. The Section 179 and bonus depreciation deduction. A lot of people get confused about Section 179 and bonus. Bonus depreciation basically is 100% of whatever you purchased in 2021, which means even though it was supposed to be depreciated, you can just tax deduct it automatically for 2021. But for Section 179 was an IRS code that was created a long time ago that was intended to duplicate something like this. It started out very, very low. I think it was somewhere in the $10,000 range, and it has grown tremendously through the years. The Section 179 limit is $1,080,000 that is immediately tax deductible. The confusing part is, well, so what's the difference? Why 100% is bonus, or I could take Section 179? The difference really comes down to your state income tax rules. A lot of states don't follow the IRS's guidelines. Again, California, for instance, Pennsylvania, those are states that have a $25,000 cap on Section 179. However, depending on how that state legislature has moved, some of them actually will cooperate with bonus depreciation, even though they don't cooperate, so to speak, with Section 179. So the format that you elect to tax deduct your equipment or assets that you've purchased this past year has a big difference on your state income tax. So make sure that you've maximized the election and chosen the one that's right for you in your particular state. These deductions work for new or used equipment as well, and it must be placed in service before 1/1/23. Let me talk a little bit about that placed in service, because that's a very, say, stepped on rule quite a bit. The IRS's rule, so you understand, the IRS rule is that you must purchase the equipment. You can sign a loan, or you don't have to actually pay cash for it, but you can be committed to by a loan, and that it has to be in your office, plugged in and available for use by midnight on 12/31. Now, available for use doesn't mean it was used. It just had to be plugged in and capable of doing it as of that night. What I constantly have gotten questions throughout the years, though, I say, well, okay, Bob, I really want to buy some equipment, but I don't know if they're going to be able to deliver it by 12/31. Can I still, if I write the check, can I still tax deduct it this year? I have to tell you, of course, the answer is no, technically. But I would tell you that in the accounting world, this is pretty much like doing 56 miles an hour in a 55 zone. I'm not going to lie. There's an awful lot of people that have said, look, I don't know. The IRS is not really going to know specifically when this equipment was placed in service unless we tell them. And here's the worst possible case. Let's say I bought $100,000 worth of equipment and it was not ready till the 2nd of January. So the problem is, even if I took a deduction in 2021 tax return for that, or this year in 2022, instead of 2023, if the IRS were to come back and audit them, they would say, well, I want to take it away from one tax year, but I admit that we would be able to add it back to the next. And so it's an awful lot of paperwork for the IRS to go through in order to deny a deduction, only to add it back to the next year. Again, I'm telling you, the right answer is no. It's not supposed to be deductible, but I just want to make sure you understand that it's also illegal to go 56 in a 55 zone. I'll let you decide how far you want to bend the rules. Okay? But here's how I wanted to try to weave that, or talk a little bit about that, the tax effect of that equipment. A lot of people don't realize, the tax impact of buying this equipment. Everyone says, well, yeah, it's deductible. I understand that. But it's not just the actual taxes you paid for this particular year. It also has an impact for many of you on the estimated taxes you're going to pay in the following year. So it has a huge difference in cash flow. Look at this example here. If you purchased $150,000 worth of equipment on November 1st of this year, and you bought it under one of the many Schein programs or any the financial institutions that have no payments for the first 6 months. We're all familiar with many of those options. You would have a $45,000 tax deduction for 2022, but it would also reduce the amount of the estimated tax payments you would be required to pay by April 15th of 2023 for 2023. That's $55,000 of extra money that is now in your hands right now for equipment that you just purchased that you haven't paid a penny for yet. I mean, you're up $55,000, and the point is, people say, "Well, I'm worried about adopting new technology, or I don't know if I want to adopt this particular equipment." Well, you've got a pretty big cash flow help to enjoy the learning curve, right? This takes away a little bit of the angst of some new technology, but I would tell you, remember, the $10,000 in taxes is not taxes saved. It's a reduction in the estimated payment. So it does reduce all the rest of those estimated payments throughout the year of 2023. Now, it doesn't mean you don't owe the tax. It just means you don't have to pay it until April 15th of 2024. Now, that's a long time away. I guarantee you, to anybody listening, if I said to you, I'll tell you what, I'll give you $40,000 today and you don't pay me back, you pay me back with no interest about a year from now. And that's a pretty sweet deal. But it really does help the cash flow associated with, some changes, some building improvements, modifications, the things that you're going to do. These tax deductions have a lingering effect in the following year on the potential for cash flow. And again, we talked about it. It does affect it. The reason I studied it was I saved $45,000 the first year, but only saved $10,000, which is not 1/4 of that. Is that many taxpayers are required to pay 110% of the tax that they paid in the prior year. And so that reduced that amount a little bit. But let me just tell you again that anything you can do to postpone paying $40,000 of tax out into a 4/15 of 2024 is probably a worthwhile endeavor. I think most people would agree. And these things apply to every entity. I mean, I use the example of a sole proprietor or an LLC who's making estimated tax payments, but it's the same thing with an S corporation. Many of you have estimated tax payments that would apply to your K-1. Even C corporations can benefit by adjusting your payroll, but it does take a lot more planning with a C corporation. I suspect few of you are probably C corporations, and so that may only apply to some of you, but again, it applies to every entity. So realize that it's worth planning for no matter what type of entity you've got. Here's the example that I wanted to weave into this QBI deduction in Section 179 bonus. This is really important. I think of all the things tonight we're going to talk about, this has the potential to save all of our attendees more money than many of the other things we've talked about already tonight, just by making sure you've planned this properly. Let me show you this example in the first column here where you see what says without Section 179. Now, this could have been bonus depreciation 179. I'm using the example of saying, what happened if I bought $150,000 worth of equipment? I'm on the fence. Should I do it? Should I not do it? 2022 is winding down, and I'm perplexed about whether this is the best time to do it. So let's just say I don't do it. That's the first column without Section 179. If I had a practice net income of $470,000 and $29,000 in itemized deductions in my other example, I'd have taxable income of $441,000. But if you look at the up above on the slide, it shows that the 2022 income limits for the phase out for the QBI for dentists for joint taxpayers is between $340,100 and $440,100. Between those two things, that starts to get reduced and gets phased out. So by the time I get to 440 and 100, I have zero QBI deduction left that I'm permitted to take as a dentist. So that, again, wiped it out. Look what happens, however. If I decided to buy $150,000 worth of equipment this year and take a Section 179 deduction for the whole thing, I've lowered my taxable income to $320,000, or my practice net income to $320,000, and taxable down with the itemized deductions at $29,000. But now, because my income is lower than the $340,000 beginning limit for phase out, I get a full 20% tax deduction on $320,000. Let me just repeat that one more time. I get a $64,000 tax deduction for free. Let me mention for free again. Because I not only got to write off the $150,000 worth of equipment, I got to write off another $64,000 on top of that because I planned so perfectly to get the two to combine one with the other. And even at this income level, that has a tax rate of effect of 41%. $61,000 is saved the first year you purchased that equipment. You paid $150,000, you got $61,000 of it back right away. And so planning timing your equipment purchases, build outs, additions to the practice, and looking at your taxable income is absolutely critical for tax planning before year end. So make sure that you've looked, if nothing else, at this one slide tonight and said, hey, if I'm in those limits, if my practice is, above, I'm married and it's above $340,100 of taxable income, what could I do? What should I do? Is this a good year to make a change? So you can see what enormous impact that one piece of equipment in this example would have had and how that changes tax planning dramatically. One of the other things I see forgotten quite often is that when you're talking about relocating a practice, cost segregation studies have a big impact, as well as the potential for abandoned leasehold improvements. When you I call it abandoned, the unamortized leasehold improvements. In this particular example, let's say you did a leasehold improvements of 2011 on $300,000. You moved into a space and you did all the fit out, and now you've outgrown it, and you decide to relocate your office in 2021. Some of your tax returns are not filed yet for 2021. When you leave that office building, you would get an immediate tax deduction for the $215,000 in leasehold improvements that were still unamortized or not tax deducted yet, because they were abandoned and left all at once. And so getting an immediate tax deduction like that when you're thinking of relocating your practice can have a huge impact by obviously creating tons of tax savings at a time when you need them the most, because you've got the angst of a brand new project and a new loan. So just don't forget about that aspect if you're considering moving. The other thing is a cost segregation study. I always call this how to turn studs and drywall into 179 deductions. The Hospital Corporation of America won a court case years ago against the IRS. The IRS says that most commercial buildings have to be depreciated for 39 years. It's 39 and a half, call it 40 years. You get half 1 year and half the last. And the Hospital Corporation of America went to the IRS and said, look, this is ridiculous. We build these buildings and I have carpeting and I've got lighting fixtures. I've got all these things that will never be here 40 years from now. So we're going to depreciate it the way we want to. And they actually won. The courts came back then and said, well, okay, you're right. It's not going to last 40 years. The IRS then created a whole series of complex rules that you have to follow in order to break a building down into its components. And that process is called a cost segregation study. But in this particular example, let's say you had $1 million in building costs and it was going to create 40% tax bracket, $400,000 in tax savings. The thing is, it would take 40 years at $25,000 a year if you don't do a study. If you did a study, many, many times, and I'm being very conservative, 20% of the cost of that building would wind up in that 5-year category. And that 5-year category is immediately tax deductible under Section 179. So you can see that doing a cost segregation study would save about $80,000 in additional taxes in the first 5 years. And again, when do you need it the most? It's when you just built a big building, you've got a lump in your throat, and a big mortgage. So that $80,000 would come in very handy. The actual calculations look like this. I won't bore you with all the details. Just realize that I want to point out that if you own your own building, this particular analysis is what we're talking about, but it also applies to tenant improvements. So regardless of whether you own the building or whether you're just leasing and you've done tenant improvements, consider a cost segregation study. We're going to talk about the timing here in just a minute. Again, if nothing else, just remember that on the cost segregation, this is what you want to know, that without it, it's $1 million and it's depreciable all in one big lump. With it, you can break the building down into pieces. As a quick example, everyone knows this is an outlet, but the real answer is, well, it depends on what's plugged into it. Because if a fax machine is plugged into it, then it's a fax machine. And the actual outlet, the wiring, and all the components that go all the way back to the breaker, even part of the building permit, broken down into little tiny pieces, it becomes about a $380 tax deduction just because now it's a fax machine rather than a, quote, outlet. Same thing with a wall sconce. It's just decorative, so it's not 39 years. It's something you could depreciate in a 7-year category. The plumbing and all the infrastructure and the things now under the building, again, all of that becomes things that are dental equipment. And for many, all the plumbing to an operatory, all the electrical to an operatory becomes equipment, not building. And so that's the importance of trying to say, well, can I break this building down? The actual load-bearing walls and the roof don't qualify. And land never qualifies. So it's just the actual building part of this that we're talking about here today. One of the important things, though, is the actual timing. So let's say that I built a building and I just put in all new equipment full of operatories, and I've got a big tax deduction. Maybe I already bought $300,000 worth of equipment in order to fund this big project. So I don't really need that. That put a big dent in my income. Right, so that's okay. So I don't really need to do a cost segregation study in year one. what I really need to do is then say, okay, how about if I purposely time my cost segregation study and wait till year 2 or even year 3? You can then in year 3, now you've lost the benefit of all that immediate, bonus depreciation, 179 because of the day you moved in. You can now take a tax deduction for the building component portion of that retroactively. When you do a cost segregation study, the rules say that you could now take as depreciation all of the depreciation that I could have taken in that first year, 2, 3, all at once. Again, maybe in year 3. In year 3, the practice is expanded. Your taxable income's up. You're looking for tax deductions and much more then. And so that's why it's important to really look at the timing. The other thing that I remind people is that, I'll have someone come up to me and say, hey, Bob, I didn't pay any taxes at all last year. And I went, well, you lost. And they'll, what do you mean? Why did I lose? Well, taxes were on sale when they were only 10%, right? You missed out on a sale. Look at the chart on the left here. So for a married individual, you can have up to $19,900 and it's taxed at 10%. Right? So with your itemized deductions of $25,000 on top of this, et cetera, you've got a fair amount of income and it was only taxed at 10% or $1,990. Well, if I use some of my Section 179 or my bonus depreciation to get that income down to 0, I only saved $1,990. That's not what you really wanted to do. You want to try to save those deductions for the bigger tax brackets. I argue the taxes are on sale when they're only 10 or 12%. You want to try to use those deductions in the 22%, 24%, 32% brackets and higher because that's when they have the real bang for the buck. So deciding on whether or not you're going to actually take, a deduction for depreciation, accelerated depreciation, whether you're going to do a cost segregation study in this particular year. Again, you're going to make that decision based on the tax bracket you would be in, whether you didn't do it. And that's going to be the drive the portion. Remember, too, that Section 179 is not all or one. Let's say I bought $300,000, I bought a $150,000 single piece of equipment. I don't have to take $150,000 or nothing as Section 179. I'm allowed to pick the amount that perfectly matches what I want for that particular year. Maybe $50,000 deduction put me right in the sweet spot where I'm now still enjoying at least a 22% tax or 24% tax savings on that $50,000. And, my taxable income's down to $80,000, $90,000. Well, that's fine because then your taxes are on sale. But again, just don't work to get your tax liability to 0 because I think you really have lost and wasted deductions if you've done that. I want to jump over to HSAs, ROTHs, and 529s. So I just want to do a sort of a higher overview of all of that tonight. HSAs, as you know, are health savings accounts. And if you have high deductible health insurance, you're permitted to put away up to $7,300 for families. And if you're over 55, it'd be $8,300 for a family. That's not subject to any income limits. It doesn't make any difference how high you are, low, whatever. You get an $8,300 tax deduction. And the thing is that the money that is put in these HSAs grows tax-free, and it can be used for qualified healthcare expenses. And even if you don't use it, I would say that if you start early and can plan this, unfortunately, vast majority of older Americans wind up using some kind of healthcare dollars eventually. And, Medicare doesn't pay for an awful lot of everything. So wouldn't it be nice if you had a $100,000 kitty set aside for, long-term healthcare expenses down the road? So there's nothing, and especially for those of you who are maybe in a higher tax bracket now than you would be then, way better to take a tax deduction for this money today and get it in an HSA. Everyone probably knows what a Roth IRA is. It's an IRA where you actually make a contribution that's not tax deductible. However, the money still grows tax-free, and when you take all of the money out later, it's not taxable under the current tax rules. That means that my $6,000 turns into $10,000 when I retire, and I take $10,000 out. None of it's taxable to me in retirement. There's been some talk about, down the road, will there be an excise tax that'll have to be placed on IRAs? maybe Roth IRAs that are over $1 million, something like that. Again, none of that is in place right now. So for today, realize it's tax free. A lot of people say, well, I'm not eligible for a Roth. My income's too high. But they have what I'm going to call it the backdoor Roth IRA. Everyone is eligible to make a contribution, no matter what your income size is. You can make an annual contribution to a non-tax deductible traditional IRA. A non-tax deductible traditional IRA would have been one where you don't tax, or you don't get a tax savings on the contribution. The actual income grows tax-free, but you do pay tax on all the income when you retire. Not a very favorable plan. Some people do it, but here's the thing. If you actually make a contribution to one of those non-deductible plans, and then the very next day convert it to a Roth, that's legal. The IRS has talked, Congress has talked several times about trying to fix this loophole or make it permanent. You just skip the whole gymnastics of trying to create one IRA and then telling your broker I want to, move it to my other IRA the next day. It still hasn't come to fruition yet. So realize that for 2022, you still have the eligibility of doing one of these backdoor Roth IRAs. And consider the possibility of the 529 plan. If you have children, if you have other beneficiaries, nieces, nephews, anyone that you want to try to help out, these Section 529 plans are nice because you put the money in the plan. You don't get a federal tax deduction for it, but the money does grow tax-free, and it's tax-free to the recipient as long as they use it for qualified education expenses. The big thing is that you can put up to $16,000 per year per donor into a plan like this under the current federal gift tax rules. So husband and wife could put $32,000 away into a plan like this and not have a gift tax issue. And remember, though, several states do have, while there's no federal tax deduction for a 529 plan, several states really do have some level of state tax credit. Quite often it's not the whole thing, but it's something that's going to be a deduction for those 529 plans. Let me jump over to talking about that right pension plan. Remember I said, you want to make sure you've got the right size shoe on your foot. So basically everything starts out with, I've started this with a basic IRA of $6,000, right? That's the beginning of any kind of pension planning. The next level up is the simple IRA, and that's when you own your own practice and you've got the ability to make a business deduction for this. That's a maximum of $14,000 plus 3% of your income. So depending on where that lies, again, you could be in the $20,000 range depending on your practice income. The 401k plans jack it up to a $61,000 deduction, $67,500 if you're 50 or older. So you need to grow into that plan if $20,000, for instance, doesn't enough to meet your goals, or you have more money that you could potentially invest. It goes up to the defined benefit plans with a maximum combo of $245,000. Even if you put these two things together, the maximum is $245,000. But I would tell you that if you want to put away more than $61,000, many times, piggybacking these two plans helps you really reduce the employee cost. Because especially if the doctor owner is older on average than the typical employee, many of these defined benefit plans and cash balance plans really favor the doctor and lower the cost of the actual contributions and the cost of the staff, and for as far as that overhead goes. So, again, if you're thinking about the possibility of putting away more than $61,000, look at combining these two plans and see where that would take you. Again, I always tell clients, make sure you're asking yourself the question, do I have the right pension plan? Because you can switch, from one to the other in a different year and, pick the one that's right for you. Talk quickly about some deductions that a lot of dentists miss. I would tell you what's really become popular is that, dentists are treating associates as independent contractors. Be very careful. First of all, in many, many states, an independent contractor who's an individual who gets a 1099 with their social security number on it is probably violating all of the state employment rules. If you have an associate that works for you, and you tell them when to work, you give them all the equipment, you tell them what fees they're allowed to charge, you basically control everything about them, and they're basically an employee. And if you try to treat them as an independent contractor, the penalties for the host dentist could be really severe for treating them as an independent contractor when they're really not. The way to get around this in many states is to actually create a different corporation, because the rules that the states apply are the question of an employee versus independent contractor. Talk about an individual person with a social security number. However, when my dental practice contracts with another corporation to provide dental services for me as a subcontractor, now I have a business-to-business relationship. It's not a business to an individual relationship. So make sure that if you're hiring any associates, they all have their own corporations set up, their own entities set up. But for those of you that own those entities that are the associate doctors, many people forget that, when you were in dental school, you purchased all sorts of things that were now for educational purposes that you're now about to convert to business use. And when you convert them to business use, they are tax deductible. So make sure you make a list of those if you're a new graduate and you started your own LLC. The other thing for a few of you that didn't realize is that if I started as a general dentist, even worked 6 months, and decided to go on to train for a specialty, the tuition for that is actually considered continuing education and tax deductible. A lot of people forget, if you cannot go directly from general dental program into a specialty program. You have to actually be in business and be working, and then own your own LLC, and then say, I'm now going to use this as continuing education. So again, for the few of you that might be of interest to, make sure you talk to your tax advisor about that. One of the other things I want to talk about is just the tax-free rental of your house. This has come up quite often. You'll see this in various publications. When the Olympics were in Atlanta, I think back in '76, the United States was embarrassed. We didn't build enough hotels fast enough. And Congress came up with this idea that said, listen, if you rent your house for 14 days, then we're going to let you have the income completely tax-free. That'll be an incentive to the original Airbnb to move out and let some people move in. The rule's never been taken off the books. So for those of you that really do want to have meetings at your office, at your home, if you do want to have, private meetings, have staff retreats or some things there, it is possible for you to rent your house to your practice. Can't do it more than 14 days, and it's got to be at fair market value. So, go to your local banquet center and ask them what it would be to rent a room for the day, and then use that as the fee that you pay yourself back for the use of your house. A lot of people also don't know about family limited partnerships, especially for wealthy doctors that are looking for ways to spread out the wealth and spread out the taxable income and the inheritance tax issues. Family limited partnerships can be great, because if you have a building, for instance, that's owned by an FLP, you can have children as partners and what's called anoint them or gift them the actual income. So their K1s, especially if they're over age 24, their K1s could be higher arbitrarily. Even though they only own 1%, you could actually give them more than 1% of the taxable income in an FLP because of the rules of attribution. So again, make sure that at least you've talked about whether an FLP is right for you. And when it comes to gifting, again, the current estate tax exemption is $12 million per person. I hope all of you are all over that and you're all, Bezos wealth and worried about that. But the reality is a lot of people are not too concerned when it's 12 million per person. The problem is that Congress is working on a plan that could reduce that to 6 million. They've been bouncing this around for several years now, so I don't know that it's going to happen. But I would just say that, again, if you have a significant estate and just make sure you're considering the possibility of using some of this lifetime $12 million exemption. Because if you use it, they're not going to make you take it back. It's a use it or lose it if they do reduce it. So make sure you're talking about gifting if it's appropriate for you. And lastly, let me throw in the reminder about the Phase 4 grants. You have to, if you got a Phase 4 grant money, you have to tell HHS how you spent the money. You have to actually log in and fill in all the information. Otherwise, you're going to wind up having to repay those funds. So make sure that you're on top of your reporting for all your different phases of grant money as well. Again, tax planning is really complicated. I'm glad everyone's here now before the end of the year so we can talk about this and sort of light the fuse, at least get the conversation started. You also have seen what a big impact equipment purchases can have. And again, choose wisely before taking accelerated depreciation. Taxes are on sale when it's only 10%. And don't forget the cost segregation study. It can have a big effect. My contact information is here. For any of you who are interested, you could shoot me an email if there's something else that comes up down the road. We're always happy to have a discussion with clients who would like to have their tax returns reviewed on a complimentary basis. We would take a look and see if there's some suggestions we might be able to make or ways that we could help. But I wanted to save time for now for questions at the end, because I think that's sort of an important part of attending one of these where you can actually say, well, that's great, but how about me? Here's a question that I have, Bob. So let me leave the last 15 minutes here for some questions, and I will let the promoters take it from here.
Thank you so much for a great presentation. As mentioned, at this time, we're going to open up for a live Q&A session for the webinar. If you have a question, please type it in the box labeled "Have a question" on the right side of your screen. One question we did see being asked was if the slides are going to be available for download. And we did record tonight's webinar, so we will be sharing that with you all via email within the next week. Any additional questions, please type them in the box.
While we're waiting for any other questions, let me just talk a little bit about S corporations as well. I know that many of you are S corporations, and one of the things I wanted to point out, if in fact let's say that you are not an S corporation right now, you are a sole proprietor, an LLC, and you're filing a Schedule C on your tax return, but you have $500,000 of income, and so you're not really eligible for the QBI. The best thing you could do in that particular example is become an S corporation, because at least with an S corporation, now you could limit your Medicare and Social Security taxes by reducing, only having a portion of your income come through a W-2. The rest would come from a K-1 that is not subject to the total for Medicare taxes. And that can be a big tax savings. And again, we have to look at what state you're involved in. There are some corporations, some states that do tax S corporations, and that tends to minimize some of the benefit. But there are very few states in which being an S corporation is not helpful if your income is over $500,000, say, in my example, or over the $440,000 that would have gotten you a QBI deduction. So if you can't get that, now try to make sure that you've maximized the minimization of that Medicare taxes by using an S corporation.
So Donald let us know that his daughter joined his practice 3 years ago, and now needs to structure things for her to become partner, have someone replace him clinically. And does it sense to stay on as CEO of his corp? He says he owns freestanding building and pays his daughter as an employee, and they use PEO.
Well, I would tell you that for anybody, the answer is obviously it depends is the correct answer. But clearly, if you stay on as the CEO of your S corporation and you have benefits associated with that, if you have a pension plan, if you have things like that, you're going to be reducing your income by continuing, because regardless of your age, as long as you have W-2 income, you're eligible to put money into a retirement account. So clearly, I would say that it's again, if you said, listen, I've already got $10 million in my pension account, I really don't need any more, now then maybe it doesn't make sense. But for the vast majority of people, having that tax deductible forum where the practice can continue to pay for things like your cell phone and auto allowance and that sort of thing would be probably a big help as well. So I would certainly say that you should stay on and, perhaps look at a stock purchase agreement to be able to cover the cost of the practice.
Great, thank you. For our next question, we wanted to see what your thoughts were on C Corps for dentists.
That's pretty much an easy answer. The answer is no. So C corporations, for those of you who don't know, are the corporations that pay their own tax. In other words, there's never going to be, you get your W-2 and you're taxed on what that W-2 is. And then whatever profit the corporation may have or loss is theirs to pay tax on, not yours. And people say, well, isn't that great, Bob? Because then the tax rates currently could be as low as 15 to 20% on corporate net income. But the problem is if I have a $100,000 profit in my corporation, and even if I only paid 15% tax on it, all right, well, now I'm left with $85,000. What am I going to do with it? Well, I'm going to give it to me, right, at some point, and now I'm going to pay income taxes on it again. I already paid 15% corporate tax. Now I'm going to pay taxes on it again when I give it to me. And so there's no benefit to double taxation. There are some very minor, benefits of C Corps when it comes to having certain benefits, health insurance plans and some, cash value life insurance contracts, other things that they'll do, but they are so outweighed by the loss or that double taxation on that I can tell you that there's very, very few people that should be a C Corp.
For our next question, we have, if you as an employer have a 4% company match, should you pay yourself the bare minimum as W-2 wage or max your salary at $305,000 in order to max out the 4% match? Assume highest tax bracket.
So now it's a question of goal planning, right? Where do I need the money the most? I'm going to wind up paying more federal income taxes because I lost my QBI deduction, if that's the case, right, on more money. So which was better for me? Let's say instead of the 305, I only took 205. Well, I wasted a $20,000 tax deduction. Depending on what bracket you're in, that could put, whatever, $6,000, $8,000 in your pocket. But on the other hand, you got more money in your pension. Where do you need it the most? Where's the planning? Again, for an older doctor who's looking at kind of maxing out a pension contribution, maybe that's not as exciting. But I would say that for many younger doctors, taking the 305 salary is the way to go and maximize your pension contribution. I want to do a quick shout out to Alan Schiff. I notice he's one of the attendees here tonight. He's the president of the Academy of Dental CPAs. Welcome, Alan. Glad you could join us. He's been an amazing part of the Academy of Dental CPAs for many years now. So any of you that have already met Alan, I'm sure, because he's done a lot of presentations as well. But just a quick shout out tonight. Hello, Alan. So
great. And he also gave you a shout out and wanted to let you know that he's so proud of you for sharing your amazing knowledge with the attendees, and a well done job.
Thanks.
So if we have another question, Mary states that she started a practice as an S Corp this year. Her former group practice wants her to fill in 15 to 20 days this year for a dentist that's out on leave. Is it okay if they pay me as a W-2 employee like she used to be before she became S Corp?
If she became an S Corp, I want to make sure I understand the question. She was an S Corp that was working for another practice, or she had an S Corp as the practice?
She started at a practice as an S Corp this year, and then her former group practice wants her to fill in 15 to 20 days this year for a dentist that's out on leave.
Yeah. Now, the answer is do not be a W-2 employee to that practice. Clearly, if you have an S Corporation, you could contract as B2B, corporation to corporation, to have your S Corp provide those services, because then the money could go into your S Corp and be used to help fund pension and other benefits for you and your S Corp.
Yet another question that states that you mentioned that when you use the depreciation, they were just looking for more insight on how you're spreading out the 1 to 5 year depreciation.
Well, so the depreciation for 1 to 5 years is an option. If a portion of the building, for instance, the plumbing that goes under the floor that feeds an operatory, is now considered dental equipment, that would go into a 5-year category. The cost of that plumbing and all the installation. Now you have the election to say, I could take 179 on that plumbing. I don't have to, though. I could actually spread it out and say I'm only going to take part of it as 179, maybe none of it, and just let all of it be spread out over that 5-year depreciation period. But that 5 years is still way more compacted than 39 years of depreciation. So much better to make sure it got in that 5-year category to begin with. That was the point of the cost segregation study.
So we had a new question come in that many are touting the employer retention credit and are promising large tax credits. We're skeptical, but wonder if they're leaving money on the table in the practice.
Wow, what a hot topic. I apologize for not actually addressing this. I should have earlier this evening because it is, again, a it's rampant out there. The number of companies that are coming to you saying, hey, for 30% of your refund, we'll file this enormous tax credit for you, and you're entitled to all this money because of whatever. Here's the thing. It's very clear the employee retention tax credit was created by Congress to reward you for continuing to pay your employees at a time when it was difficult to afford to do so. Now, I'm not paraphrasing Congress, but that was, I believe, was the intent. They went on to say that if, for instance, in 2020, if your Q2 2020 income was down 50% or more than it was in the Q2 of 2019, you're automatically eligible for the employee retention credit for that quarter, and several quarters to come until your income recovered back to 80%. That's the safe harbor. That's clear that you're definitely entitled to it. If you're in that category, file the employer retention credit, take the money, you deserve it. That's what Congress intended. The problem is all these other companies are going to be running around saying, oh, no. All you had to do is be affected by the pandemic, and now you get that. Well, that's not what Congress said. And I would tell you that they're really bending the rules. And I would never sign a refund request for a client just who didn't have any loss of income, just said, oh, well, I had to stretch my patience out a little bit farther. I had to work harder. I had to spend a little bit more money on PPE. That's not what the ERTC, the Employer Retention Tax Credit, was intended for. I would step very softly when you're talking about using some of these companies that are taking a very broad approach to that employer retention credit.
Great. Thank you so much, Bob. This wraps up our Q&A session. Thank you so much for a wonderful presentation this evening, and thank you all for joining us tonight. We did record tonight's webinar, and we'll email the recording out sometime in the next week. We would appreciate your feedback via our survey that will pop up on the end of the screen shortly. Thank you all for joining us, and we look forward to seeing you on future webinars.
All right. Thank you all.